Good evening. This is the post-market recap by AGI Era. Today is Wednesday, December 31st, 2025, and it is shortly after 4:30 p.m. Eastern Time. The closing bell has rung on the final trading session of the year, and we have a lot to unpack from today's session. The scoreboard and technicals. The U.S. session has officially wrapped, and the price action suggests a decisive victory for the bears to close out the year, though the context of the day's volume is critical. The S&P 500 finished the day down approximately 0.74%, settling at 645.5. Technically, the index showed weakness, opening near the 6,900 level, but failing to hold, ultimately closing on its lows for the day. This suggests sellers were in control straight into the bell. The Nasdaq 100 led the declines, closing 0.84% lower at 25,249.85. The Dow Jones Industrial Average finished down by about 304 points. Crucially, trading volume today was lighter than average, which is typical for a holiday week. This implies that today's sell-off lacks strong institutional conviction. It's more indicative of year-end profit-taking and position squaring rather than the start of a new bearish trend. Market breadth and sentiment. Under the surface, the fear gauge, or VIX, saw a slight uptick with the market decline, but remains historically subdued, suggesting this is a controlled rotation rather than outright panic heading into the new year. We are seeing a clear divergence in sector performance, albeit with broad weakness. Money flowed noticeably out of the rate-sensitive technology sector, XLK, which fell nearly 1%, while the defensive utilities sector, XLU, performed better, down only about 0.63%. This rotation, even on a down day, indicates that Wall Street is positioning for a potentially more challenging growth environment and is shedding risk in the names most sensitive to interest rate fluctuations. The macro engine room, the primary driver of today's moves, can be traced back to the bond market and strong economic data. The 10-year Treasury yield felt upward pressure today, following a stronger-than-expected initial jobless claims report, which showed the labor market remains resilient. This move is significant because a robust labor market gives the Federal Reserve less incentive to cut interest rates aggressively. This directly creates a headwind for growth-oriented sectors like technology, which rely on lower borrowing costs to justify their high valuations. Meanwhile, the U.S. dollar index is ticking higher to 97.98, reacting to that same economic strength. Crude oil is trading around $57.45 a barrel. Despite a report showing a larger-than-expected drop in inventories, the stronger dollar put pressure on the commodity, weighing on prices. The AI and Tech Monitor. Turning to the leaders of this market, artificial intelligence and big tech. It was a sea of red for the Magnificent Seven. NVIDIA finished the day down 0.55% at $186.50. Microsoft closed down 0.799%, while Apple also declined by 0.45%. Other notable movers included Tesla, which dropped 1.04% to close at $449.72, and Meta, which fell 0.88%. The weakness in this group is notable because it's a direct reflection of the macro story. As the market digests the reality of a strong economy, the higher-for-longer interest rate narrative regains some traction, prompting investors to take profits in the year's biggest winners. After hours and look ahead. Looking at the after-hours tape right now, we're seeing some isolated pockets of activity. Shares of Sidus Space Inns are moving significantly, last seen up over 28% in the post-market session. As we pivot to tomorrow and the new year, the calendar brings us the ISM Manufacturing PMI and, most importantly, the minutes from the Federal Reserve's last meeting. Investors should specifically watch the language in those minutes for any clues on the Fed's conviction about future rate cuts. That is your comprehensive closing update. We will see you tomorrow morning for the overnight brief. Disclaimer: this podcast is not financial advice. Data may be delayed. Always conduct your own due diligence.